Welcome to the deep dive. We take complex source material, boil it down, and give you what you really need to know. Today, we're jumping into a financial hot zone, transportation expenses.
Yeah, specifically the local kind.
Right. If you drive for work, maybe run your own business, or even just grab an Uber sometimes for a client meeting, you know this area can get confusing.
It really can.
So our mission today is pretty crucial. We want to draw a really clear line between your everyday non-deductible commute and that essential business transportation that is a legitimate write-off. We want to make sure you don't leave money on the table or accidentally walk into a financial trap.
And we need to set the stage right away. We're talking transportation here. That means, the costs of getting around locally, gas, car maintenance, maybe bus fare, taxis, that sort of thing. But it all really hangs on this idea of your tax home.
Ah, the tax home. Okay.
Yeah, for what we're discussing, your tax home is basically the whole city or general area where your main place of business is. Doesn't matter where your family home is necessarily. And if you don't have one main place of business, then it's wherever you regularly work. This definition is kind of the geographic anchor for everything else.
That makes sense. So that distinction it's vital. We're talking local movement, not travel, like in the sense of an overnight stay.
Exactly. Travel involves staying away overnight. It's a different beast, different chapter, really.
Okay, let's unpack this then. When are we allowed to deduct getting around town for work? Because, the default assumption is often never, right?
Pretty much for commuting.
But the sources lay out a really clear list. 4 specific situations where ordinary and necessary costs do count as deductible transportation. Let's call this the gold list.
Yeah, thinking of it like that is helpful. These are the standard low-risk areas where you can generally claim a deduction. Solid ground.
Okay, scenario 1. This one feels pretty common for a lot of businesses. Getting from one workplace to another workplace during your business day.
Right.
Think about how that works practically. Maybe you're a consultant. You start at your main office, then you drive across town to a client site, maybe a co-working space to work with their team. Then later you drive to meet a supplier. All those trips, those are business movements. All deductible transportation because you're moving between different work locations within your tax home area.
Exactly. It's not like you're just driving around for fun. It's essential movement to actually do your job, to generate income.
Which leads nicely into scenario 2, visiting clients or customers.
The classic example.
Yeah, this is the lifeblood for so many service businesses, salespeople, contractors, the cost of getting to that client's office or their site. Whether you're taking a taxi or trekking your mileage, that's a write-off.
Absolutely. And sometimes people get hung up on needing detailed meeting notes for the transportation part. But the key is the purpose. If it's clearly a client visit related to your business, the transportation cost follows.
Okay. Scenario 3 feels similar, but it's about a different kind of destination. Going to a business meeting away from your regular workplace.
Right. Not a client visit necessarily.
Exactly. Could be a required training session across town, or maybe a strategic planning meeting offsite, or even a networking event at some hotel conference room. If the meeting's purpose is business and it's not at your usual desk, the cost to get there counts.
Simple as that.
And then scenario 4, this one. This one feels like the trickiest on the gold list because it involves starting from home.
Yes, the home departure point.
It's getting from your home to a temporary workplace,
Yeah.
and this is the key part, only when you already have one or more regular places of work.
That condition, having an established regular work location, is absolutely critical.
Yeah.
Without it, the trip from home is usually just commuting.
So give us an example.
Okay, let's say you're an accountant. Your regular office is downtown. That's your established spot. But for, say, 2 weeks, you're assigned to a specific project at a client's factory way out on the edge of the metro area. The source material confirms that driving from your home directly to that temporary factory site and driving back home is fully deductible.
Even though you started at home.
Even though you started at home, because the factory is temporary and you have that regular downtown office. And interestingly, the sources point out, this temporary place could be inside your tax home area or even outside it. The temporary nature and the existence of your regular spot are what matter.
That's a really important distinction because the second that factory job stops being temporary and becomes, say, permanent or just another regular place you go,
then that deduction typically disappears.
Right.
It becomes a commute again, unless, of course, one of the exceptions we're about to talk about applies.
Right, the exceptions. But before we dive into those, I want to circle back to something you mentioned earlier about travel. You said there's an overlap even though we're focused on local.
I did, yeah. And it's worth remembering, it's a bit of a crossover.
Mm.
If you use your car while you are traveling away from home overnight, so you're in that travel expense situation, deducting hotels, meals, etc., the source says you still have to use the rules from this chapter, the transportation chapter, to figure out the car expense part of that deduction.
Ah, okay.
So basically, whether you drove 20 miles cross town or 200 miles on that overnight trip, the way you calculate the mileage deduction or the actual costs of using your car,
Yeah,
those mechanics come from these local transportation rules we're discussing now.
gotcha. That's really good context. But let's face it, for most people, the everyday headache isn't the occasional big trip, it's that drive from home to work.
The daily grind.
Exactly. And we know the general rule. Driving from your home to your regular place of business, that's commuting, non-deductible. End of story.
Usually.
Usually. Because here's where it gets really interesting. The source material points out three major exceptions. Exceptions that can turn what looks exactly like a non-deductible commute into a genuine, legitimate write-off.
And these exceptions are really essential for you, the listener, to understand because they depend heavily on how your work life is structured. It's actually kind of fascinating how the IRS draws lines between regular and temporary and how much location and having a principal office matter.
Okay, lay them out for us. What's exception one?
All right, exception one. We could call this the distance rule. It's about temporary work that's far away.
Far away how?
The rule says you can deduct your daily transportation costs when you're going between your home and a temporary work location that is outside the metropolitan area where you normally live and work.
Outside the metro area. Okay, that's a clear line.
It is.
So let's paint a picture. Say I live and mostly work in Chicago. That's my tax home. But I take on a 6-week project in Milwaukee that's definitely outside the Chicago metro area.
Right.
Because that Milwaukee gig is temporary and it's outside my usual metro zone, the drive from my Chicago home to that Milwaukee site. That's deductible.
That's deductible. Every mile, back and forth. The distance and the temporary status are the keys. It shifts it. It's no longer just seen as your personal choice of where to live versus work. It's considered a necessary business cost to service that temporary job outside your normal economic area.
Okay, that makes sense. What's exception two?
Exception two is about having multiple regular locations.
Multiple regular ones.
Yes, you can deduct daily transportation expenses between your home and a regular work location if you have one or more other regular work locations away from your home.
Wait, hang on. Why? If I choose to have, say, 2 regular offices I go to or 2 regular jobs, how does that suddenly make the drive from my home to either of them deductible? Isn't that still just commuting based on my personal choice?
It's a really good question that gets right to the logic behind it. The thinking seems to be that once you establish multiple regular work sites,
Yeah.
the IRS views getting from your home to any of them as sort of necessary for the operation of your overall business or work structure.
Right.
It's not just about getting to one fixed spot anymore. The movement itself becomes integral because your work life is inherently split between these regular locations.
That's a powerful difference for anyone juggling multiple regular gigs or complex work setups.
It really is. Okay, and finally, exception three. This one is huge, especially for modern work styles for entrepreneurs. It's the principal place of business rule.
The home office rule.
Essentially, yes. It says you can deduct daily transportation costs if your residence is your principal place of business, and you have expenses going between that home office and another work location in the same trade or business.
Okay, let's break that down. So
Yeah.
if I run my whole consulting business out of my spare bedroom, like that is my main office, my principal place of business, and I have to drive across town maybe once a week to meet my main client at their office or maybe go see my accountant, that drive is deductible.
Absolutely. And here's the really crucial part of this third exception. It applies whether that other place you're driving to the client's office, the vendor, the accountant, is temporary or permanent. And it applies regardless of the distance.
Whoa, okay, that completely changes the game for what counts as a commute, doesn't it?
It really does.
If the foundation, the principal place of your business, is your home, then driving to almost any other necessary work-related spot seems to become business travel, not commuting.
Pretty much. The home office status becomes the linchpin. It dictates whether driving your car locally for business is deductible.
That gives enormous flexibility, I imagine, to remote workers, freelancers, home-based business owners.
Massive leverage. If you legitimately qualify under that principal place of business rule, you basically unlock the deduction for a huge chunk of your local driving that's tied to your business.
This is incredibly helpful. We've got the gold list scenarios for clear deductions and these three powerful exceptions to the commuting rule. But even if you follow all these rules, get everything right, there's still a way to lose the deduction right, an administrative trap.
Yes, and we absolutely have to cover this. The source material has a big caution about it dealing with employer reimbursements.
Okay, what's the trap? It sounds like something that could easily catch people just trying to be efficient or maybe helpful.
It often does. And it's probably the most immediate financial risk highlighted here,
Hmm.
especially because of recent tax law changes. Here's the rule, and it's quite strict. If you are entitled to get a reimbursement from your employer for a business expense, but you don't actually claim it,
Hmm.
you cannot then turn around and claim a deduction for that expense yourself on your own tax return.
That still feels backward. If it was a real business cost, why does it matter if I paid it or my employer paid it in terms of deductibility?
It boils down to how the expense is classified for tax purposes. And why it matters so much right now is because a specific category of deductions got suspended.
Right.
See, historically, if an employee paid for a valid business expense and wasn't reimbursed, they could potentially claim it as something called a miscellaneous itemized deduction.
Okay.
But the tax law changed. That entire category of miscellaneous itemized deductions subject to the 2% floor, it's currently suspended. Gone. Not allowable.
Ah, I see where this is going.
Exactly. So if you're an employee today and your company policy says they will reimburse you for that taxi to the client meeting or for the mileage between work sites,
Yeah.
and you just don't bother submitting the expense report, maybe it's too much hassle, you forget, that deduction is just lost.
Hmm.
Gone for, you have absolutely no way to claim it on your personal return because the place where it used to go doesn't exist right now.
Wow. Okay, that is a critical takeaway. Don't try to be a tax martyr, basically.
Chuckles slightly. That's one way to put it.
File the paperwork. If your employer owes you money for a legitimate business expense under their policy, you have to get it from them. Otherwise, that money is just gone tax-wise.
Correct. The deduction evaporates because of how it's classified.
Okay, so let's try to pull this all together. What's the bottom line for you, the listener? These transportation deductions, fundamentally, they're about separating necessary local business movement, our gold list of 4 scenarios, from your routine commute. Unless your situation fits one of those 3 powerful commuting exceptions we talked about, especially that principal place of business rule, which can really change your whole transportation deduction picture.
And if we zoom out just a bit, connect this to the bigger picture, you see that all these rules, every scenario, every exception, they really pivot on properly defining your tax home.
Okay.
That's the cornerstone concept. It defines the geographical playing field for what counts as deductible local transportation versus non-deductible personal movement. Every judgment call, like, is this worksite temporary? Am I technically outside the metropolitan area? It all flows from first establishing where your tax home actually is.
So true. The rules we just unpacked give you these clear boundaries for deducting local driving, but those boundaries aren't much use if you haven't clearly marked your starting point. So here's the final thought to mull over after this deep dive. Have you truly correctly identified your principal place of business and therefore your tax home? Because getting that primary definition right, that's the absolute key that unlocks everything else we talked about. It determines if those powerful exceptions can even apply to you and your business.